What's going on with Nestlé? At Insightful Value, we dive deep into overlooked opportunities, and today we're pulling back the curtain on a giant whose stock price has been under pressure. Yes, Nestlé, one of the most iconic food companies in the world, is trading lower than many expected. But is it a hidden gem or a fading legacy? This review is for informational and educational purposes only, not financial advice. If you're into value investing or simply curious about what's happening beneath the surface, stick around, hit that like button, and subscribe to the channel. It helps more than you think. Nestlé is a global behemoth headquartered in Switzerland, operating in nearly every corner of the planet. With over 2,000 brands under its belt, including Nescafé, Kit Kat, Purina, Maggi, and Gerber, it touches everything from coffee and chocolate to pet food and healthcare nutrition. Its scale, supply chain, and brand power have made it a staple in consumer portfolios for decades. So why is the stock price not reflecting all that strength? Let's break it down from a value perspective. While revenues remain robust, with sales in 2024 exceeding 90 billion Swiss francs, growth has slowed compared to earlier years. The company is facing inflationary pressure on raw materials, especially in food and packaging. This, in turn, has squeezed operating margins. Nestlé has been passing some of these costs onto consumers, but there's a limit before volume starts to drop, especially in more price-sensitive markets. The good news? Nestlé continues to deliver strong free cash flow and a solid dividend. The dividend yield is now hovering around 3%, and payouts have been steadily growing for decades. That kind of consistency is rare, especially in today's uncertain environment. Management has also been executing a major share buyback program, which signals confidence in the long-term value of the stock. The company's return on invested capital remains healthy, but not extraordinary, hovering near 12%. On the risk side, Nestlé isn't immune to global volatility. Geopolitical tensions, currency fluctuations, and shifting consumer preferences toward fresher, local, or organic options are creating headwinds. There's also regulatory scrutiny on its sugar content and health claims, which could impact some product lines going forward. And with interest rates staying higher for longer, defensive consumer staples are facing tougher valuation scrutiny. So, why invest in Nestlé right now? You're getting a dominant player with diversified revenue streams, reliable dividends, and long-term pricing power. If you believe in the global consumption story and Nestlé's ability to adapt, the current dip could represent a strategic entry point. But on the flip side, if you're looking for fast growth or major margin expansion, this might not be the right moment. The market is recalibrating what it's willing to pay for stability. Dividends have been climbing gradually over the past 5 years, with payouts in Swiss francs consistently rising even through turbulent markets. That's a sign of discipline and resilience. As for a recovery in the stock price, it's possible, but it likely depends on margin improvements, innovation in healthier product lines, and a broader market shift back to defensives. At Insightful Value, we break down undervalued companies and make the data digestible. We keep it real. No hype, just clear analysis. Whether you're new to investing or a longtime stock picker, you'll find our no-nonsense approach helpful. You can find more detailed insights on Nestlé and other companies at insightfulvalue.com. Don't forget to subscribe to the channel and give this video a thumbs up if you found it useful. It helps us bring you more deep dives like this one. See you in the next one.